Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, welcome to another episode of On My Way to Wealth. My name is Luis. I'm your host. Thank you all for tuning in. I'd like to talk to you today about converting your Roth IRA during a down market. The stock market was down just about 19% in 2022. And that could create an opportunity if you happen to have some old 401k or an old IRA laying around that you would like to convert into a Roth. And I'm going to tell you why. Now, before I get into all that, for the benefit of those that may not be as familiar with the Roth, I want to just touch upon some of the basics of Roth IRAs, what they are, how they work, who qualifies, and then the benefits of converting and why somebody would do that, plus the consequences of doing so as well. So let's talk some basic. First thing, what is a Roth? The Taxpayer Relief Act of 1997 created the Roth IRA, was named after Senator William Roth, which was the major architect of it at the time. Just a little fun fact about Roth IRAs. So ever since it was created, it gave the opportunity for individuals to put money away on an after-tax basis with the idea that that money can then grow tax-deferred and ultimately be tax-free if you follow certain rules. And it is pretty much the coin flip of what we know today as the traditional IRAs. A lot of us are more familiar with 401ks. So, for example, your traditional 401k, you get to put money on a pre-tax basis. So it lowers your taxable income today as a result, and it creates some tax savings. But then that money gets to grow tax-deferred. When you take the money out, then it's considered taxable income at the time of the withdrawal. So the Roth IRA created the opportunity for individuals to put money away the opposite way. It get taxed on that money first and then contributed on an after-tax basis. That way, that money gets to grow tax-free, and then there's some advantage of it depending on your situation. As of this year, 2023, the income limits for the Roth IRA, in order to contribute, you have to make within a certain amount. So for single individuals that file a single tax return, if they make under $138,000, you can make a full contribution. Currently, that is $6,500 limit per year. And then it starts phasing out with a limited amount all the way up to $153,000. For individuals that are married filing joint, it starts under $218,000. You can make a full contribution per spouse, and then it starts fading out all the way up to $228,000. In between, you can make a limited amount, reduced based on how much money you made. After $228,000, then the contribution phases out because you're over the limits. Now, there is an opportunity for you to contribute to a Roth IRA, even if you exceed the income limits. It's called a backdoor Roth. It's easier if you don't already have an IRA balance elsewhere. And technically, the gist of it is you take the money after tax contributed to a traditional IRA as a non-deductible contribution, and then you convert that amount into a Roth. So it's kind of like a backdoor way of doing it. Obviously it's not that simple, but I wanted to give you just kind of like the gist of it. Another important fact I wanted to mention, since we're talking about income limits, is people that are married filing separate who live with their spouse. There is a pretty heavy limitation where if your adjusted gross income is zero, you can make a full contribution. And then anywhere between $0 and $10,000, the contribution amount gets reduced. So people that work, do married filing separate, and they live with their spouse, for the most part, if you make over $10,000, you're not allowed to contribute to a Roth IRA. So that's one of the many penalties that you get for doing married filing separate, unfortunately. But I wanted to mention that in case any of you listening are married filing separate and live with your spouse, because you do have some limitations there. In terms of contribution limits, usually it gets adjusted every year. So in 2022, it was $6,000 a year with an additional $1,000 catch-up contribution for those ages 50 and older. In 2023, it's $6,500. And then ages 50 and older still get that additional $1,000 for a total of $7,500. Now, the great thing is that if you're listening to this when it was recently released, you do have until the tax filing deadline to make a contribution for the prior year. So this episode airs on February 2023. If you listen to this now, you still have until the tax deadline to contribute towards 2022. So if you haven't contributed to a Roth or haven't maxed it out, there is still that opportunity to do that. And then at the same time, you also have until the tax filing deadline in 2024 to contribute towards your 2023. So there's some opportunities there for you to still plan your Roth contributions. Why would anybody contribute to a Roth? It's a great question. One reason is if you expect to be in a higher tax bracket in retirement, it will be a good idea for you to contribute to a Roth today. Because if you contribute to a traditional IRA, or let's say you're putting money pre-tax on a 401k today, you're lowering your taxable income today. But if you're going to be in a higher tax bracket later, why would you contribute pre-tax today to then pay more taxes later when you take the money out? So the idea goes based on what your thought is where you're going to be in terms of your tax bracket. Obviously, we don't all have the crystal ball, but at least you just have to act on the expectation and then plan accordingly. If you think you're going to be in a higher tax bracket, then you want to contribute after-tax dollars today so that when you do take the money out later in retirement, it costs you less. So it's really a matter of making a cost-benefit analysis on that. And that's one of the things that a CPA, enrolled agent, or good financial planner can help you determine to make that conscious decision of what is best for you in your case, in your scenario. Should you do pre-tax? Should you do post-tax? Another reason that you would want to have Roth money is to have tax diversification in retirement. Just like you want to diversify your streams of income, just like you want to diversify your portfolio, you also want to have a diversified set of assets that you have in retirement that are taxed differently, because then you can somewhat control how your income gets taxed and how those things affect other things. So let me give you this example. When you are collecting Social Security, if you go over a certain amount of income, your Social Security can be subject to taxation at different levels, all the way up to 85% of your Social Security can be taxed. If you have a Roth IRA and you're withdrawing money and it's already a qualified distribution, that income is not considered taxable income and it doesn't trigger the taxation on that Social Security, or it doesn't increase the taxation on whatever you may already be paying on your Social Security. So that would be a great planning strategy. Another one is Medicare premiums. Depending on your tax bracket, you could potentially raise the amount of Medicare premiums that you pay through your Social Security. So you want to be able to control that. If you, in a given year, you can take a certain amount of money from a Roth IRA and kind of control that bracket, and again, this is where financial planners weigh their weight in gold, because they can save you a lot of money in taxes by just doing all the proper planning ahead of time. Another thing is, there are no required minimum distributions for your own Roth IRA. Right now, there are required minimum distributions for traditional IRAs, depending on your age. And there are some recent changes to that. But in essence, the IRS at some point wants you to start taking money out based on your life expectancy on your traditional IRA, even if you don't need the money, because they want you to take it out so that they can tax you on it. A Roth IRA does not have requirement minimum distributions, which means that if you don't need the money, you can leave it there, not pay taxes, and also leave it invested longer, which is another great advantage. And finally, if you want to leave tax-free money to your heirs, leaving them money in a Roth IRA will be a great way of doing that, because when they take that money out, provided that you had the account open for 5 years, it'll all be tax-free income for them. So that could be another great strategy there. So if you are going to be in a higher tax bracket later, if you want tax diversification, if you want to not have required minimum distributions or leave tax-free income or assets, right, to your heirs, that's a great way to go. So you have to make that decision today and see what makes most sense for you, because there is a cost, right? Whatever you are contributing to a Roth IRA, you're doing it with post-tax dollars. So you got to see how much that is costing you in taxes. And then the conversions are going to cost you as well, because every dollar that you convert then gets taxed. And I'm going to tell you what a conversion is, how they work, and just things to look out for. Now, before I move on, I want to make sure that you don't confuse this with Roth 401ks. It has become more and more common for you to see employers offer a Roth option to their retirement plan. So let's use a 401k plan since a lot of people are very familiar with it. Traditionally, when you contribute to a 401k, you're able to put money in pre-tax, which lowers your taxable income today. Then it gets taxed later upon retirement. Now, the Roth option within a 401k has been a great tool because it allows people to use the same concept as the Roth IRA, except that, number one, there are no income limits. So it doesn't matter how much money you make. If you have a Roth 401k option, you can contribute to it up to the max. In 2023, the maximum amount is $22,500 per year, with an additional catch-up contribution for those that are age 50 or older. And basically, you can contribute up to $30,000 if you're age 50 or older per year into your 401k. So if you're able to max it out and you have a Roth option and it makes sense for you to do so, that is a great tool because you can contribute pretty much 3 times as much as you could contribute on a Roth IRA. So that is a great advantage there with no income limitations. So the Roth 401k has no income limits, and the contribution limit is much higher than the Roth IRA. And you could do both if you qualify. So you can still max out your 401k and you can still max out your Roth IRA. Right? So this is a great opportunity there if you're able to do that. Again, sitting down with a financial planner to figure out what makes sense for you, how to strategize, and how to take advantage of all these things. And, laws keep changing. So you want to make sure that you stay on top of that or have somebody that works with you that takes care of that for you. Now, let's talk Roth conversion. What is it? So a Roth conversion is when you take pre-tax dollars that are already sitting somewhere where you contribute them pre-tax. That could be a traditional IRA that you've had, or if you had a 401k that is from an old employer and you never rolled it over to an IRA or to a new 401k and it's just sitting there. If that money is pre-tax, you have an opportunity to take those funds and do what's called a Roth conversion and literally just convert those dollars from pre-tax to after tax. Now, the immediate consequence of that is that whatever amount of money you convert is going to be considered taxable income that year. So you want to be very cautious about that and strategic because you don't want to create a bigger tax bill for yourself without knowing the consequences, which is a great opportunity to also plan ahead. So let me give you one example. If you have money sitting in a 401k or an IRA and you want to convert those funds into a Roth, there might be reasons for that. For example, you're going to have less income that year, so your tax bracket is going to be lower. It makes a lot of sense for you to do that Roth conversion, right? Because then you're going to be paying less taxes on that. Things to keep in mind. There are no income limits. You can convert as much money as you like. There is no income limit. There is no conversion limit. So if you have all that money, you're free to convert it. The only thing you have to keep in mind is that it's going to cost you money because whatever you do convert is going to create taxable income. Now, in addition to creating taxable income, one thing to keep in mind is that conversion can also raise you in tax bracket. So it may cost you more money than expected. So this is something you want to make sure that you control, and you work with somebody that knows what they're doing. One of the things I do with some of my clients is a multi-year strategy where we kind of control that tax bracket, look at all of their income this year, the projected income for the next, and say, okay, you know what, based on what you're making, what we expect for you to make, we can convert safely X amount of dollars to keep you in the same bracket and not trigger anything else. There are some things that you can have consequences on. There are some drawbacks. So, for example, raising your adjustable gross income by doing a Roth conversion can hurt you in many ways, aside from paying income taxes. One thing is, if you raise your income over a certain level, you may lose the ability to claim or deduct certain things. For example, the student loan interest deduction is based on a certain level of adjusted gross income. So if you raise your income above a certain threshold, you might wipe yourself out from being able to deduct the student loan interest. So you want to consider that when you're going to do a Roth conversion, because it may not make sense. If you're already collecting Social Security or Medicare or about to collect Medicare soon, that can also hurt you because the Roth conversion raises your income in that year. That can trigger taxation or a higher level of taxation on your Social Security. It can also trigger you to go into the next bracket and pay more Medicare. So again, you have to do this very consciously and see what it's actually going to cost you in income tax. Will it trigger any other type of losses, like paying more taxes on Social Security, paying more taxes on Medicare, or losing some sort of credit like a student loan interest deduction? So keep that in mind. So why should you do this or consider doing a Roth conversion when the market is down? And that is a question that I had recently had one of my clients ask me. So wanted to make this episode because I figured a lot of people either might not realize this, or if they were wondering if it makes sense, then I wanted to talk about it. And the answer is it makes sense to do, because if the market is down, obviously you cannot time the market. But if your traditional IRA account is already down in value, let me give you an example. Let's say you had $50,000 in an account and now it went down to $40,000 because the market is down. If you convert those funds and put them in a Roth IRA, obviously provided you have the money to pay the taxes, so you have to do this strategically. Technically, you're taking money from pre-tax to post-tax, pay the taxes today, and then now that money is sitting in a post-tax account in your Roth IRA. So if you follow the rules, you hold it for at least 5 years and so on, when the market rebounds, now that 40,000, let's say it goes back up to 50. Now that $50,000 after it grew back is in the post-tax money, right? Which would be tax-free money if you follow the Roth IRA rules. So it gives you that additional boost, because not only are you strategically doing it in a certain tax bracket, maybe you're in a lower bracket today, you pay less taxes on the conversion, and then also you're converting money when the market is down, so that you have the after-tax growth later. And so that could be yet another strategy. So take into account your tax bracket today, your tax bracket tomorrow, take into account the value of your accounts and see if it's depressed, if it makes sense. Take into account whether you're already collecting Social Security or Medicare, or if you're going to lose any credit by doing the conversion, and then have that conversation with your financial planner and just come up with a strategy. It may make sense to spread it out over a certain amount of years. The Tax Cuts and Jobs Act is scheduled to sunset as of the end of 2025. So you have a couple of years left where it might make sense. We don't know what the tax brackets are going to be in the future. They may revert back to what they were before the Tax Cuts and Jobs Act. They may go higher, just like they were beforehand. So speak with your financial planner and see if doing a Roth conversion is right for you. This might be actually a good opportunity. So I always like to point this out, that every time that sometimes things seem like they're not going well, or they might just seem like, oh, everything's bad, there's usually a good opportunity there for some people. So the market is down. Okay, great. Maybe it's a good opportunity to do a Roth conversion. So don't necessarily focus on all the things that you hear in the media, about recession and things like that, because all that stuff could just get you depressed. Instead, trying to look at what is the opportunity here. If my long-term investing approach, it's for a very long time, then maybe it's an opportunity for me to buy and invest lower, whether it's a Roth conversion or just investing money in general. Think about it that way. Think about, how can I save more money in taxes? Don't wait until tax season to start tax planning, because tax preparation is very backward looking. You want to do it throughout the year, which is, again, why I always emphasize you can work with a financial planner that can help you. You don't need to have a whole bunch of money to invest to work with a financial planner. That's a lot of the myths that are out there. So you can work with somebody that you just pay them a fee for their advice, and they can help you do things like save money in taxes, and help save for a down payment for a house, and help save for your children's education, help you budget your money, understand your employee benefits. There's so much more to it other than just investing, So just food for thought. So thank you, as always, for tuning in. Be sure to share this episode. If you haven't yet, check out the On My Way to Wealth YouTube channel. So this is also being recorded simultaneously, audio and video. So if you want to see the video, go to the On My Way to Wealth YouTube channel, listen to it on the podcast as well, share it with your friends, colleagues, family, friends. If you like it, leave us a review. And just thank you for tuning in, and I'll see you in the next episode. And as always, send me an email, luis@onmywaytowealth.com, if you have any questions, comments, suggestions. And thank you again for tuning in. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.